Good afternoon. Welcome to CCR Wealth Management's inaugural webcast, and thank you for taking the time to join us. My name is John Maher, and I am the Chief Investment Officer here at CCR Wealth Management. I joined the firm in spring of 2005, and in total, I have 26 years of experience in investing, investment research, and wealth management. Now, I confess to you that speaking into a camera for any length of time while I fiddle with technology in front of me is not something I'm willing to put in my skill set just yet. So I'd ask you to bear with me. I'm sure, hopefully, things will get smoother in the future. As a firm, communication with our clients is of paramount importance, as well as to ensure our commentary is relevant, is timely, and hopefully is easily understood. We certainly endeavor to do this through our face-to-face meetings, whether we're going over an investment review, updating a financial plan, or if we're involved in you on some other project. Of course, face-to-face meetings are always subject to the availability of your time and, of course, your advisor's schedule. We've found over the years that our quarterly Outlook publication, which gets emailed to you, has been an effective way to get across our market views, as well as views on topics that may be tangential to the markets. Personally, I'm swamped with quarterly reviews, updates, research, and outlooks from many sources, including various asset managers that we've selected to help us fulfill our investment objectives. As the primary author of our Outlook communication, I do strive, I'm sure with limited success at times, to make our market updates informative, if not at least a little bit interesting. Our recent series on behavioral finance issues last year, as well as cryptocurrencies, are examples of something that might be considered tangential to the market. I also know, though, that so-called market updates abound and that they often make for dry reading. So now we embark on this, our inaugural webcast, to share ideas, but I hope more importantly to open up for discussion any issues which may be on your mind. The preferred format for me would be to keep this as interactive as possible, even freewheeling. I doubt anybody is tuned in this afternoon just to hear me drone on for too long. I've prepared some very brief comments today about what I guess I would call the 800-pound gorilla in the living room, namely the recent state of market volatility. But I encourage your questions, your comments, and feel free to steer the time we have in any direction you like. To go ahead and ask a question, click on the raise hand icon on your screen, and you'll be able to type your question right into the box there. I'd add here, though, that I will not be commenting on individual stocks in terms of buy, hold, or sell recommendations. We could talk about stocks if you prefer, but we'll speak about stocks in reference to underlying market themes. While I am a chartered financial analyst, this is not Mad Money. Your calls are not, or your questions are not pre-screened, and I am not Jim Cramer. So volatility in context, today I would call this segment, Welcome Back to the Land of Normalcy. Normalcy is the process of reintroducing volatility into a market that's been lacking it, and normalcy in terms of getting our monetary policy here in the U.S. back to a more normal level. I just need to get my application up here. I'm going to start out. I have about 3 or 4 charts I would like to just discuss. When we talk about volatility, 2 things I really want to go over in these charts, and then certainly open it up to questions. One is the source of volatility, and the other one would be the nature of volatility itself. This market, the volatility we've experienced last week, and frankly, volatility that we expect probably to continue to experience throughout the rest of the year, can be sourced really at its root with interest rates. The normalization of the Federal Reserve's monetary policy is well in progress. We have rising interest rates, and what you see in front of you is another source of potential volatility in the quarters or perhaps years ahead, and that is the normalization of the balance sheet. The Federal Reserve balance sheet, as you see before you, and by the way, this chart comes directly from the Federal Reserve's website. The balance sheet of the Fed prior to the 2008-2009 financial crisis was in the neighborhood of about $800 million fairly consistently. When the Federal Reserve during that financial crisis dropped interest rates all the way to zero, another unprecedented move, it did not have quite the sticking effect that monetary easement has had in the past. So in an extraordinary move, the Fed got a little bit creative, or perhaps very creative, and began on their 3 quantitative easing series. QE1, QE2, QE3 essentially were asset purchase programs where the Federal Reserve stepped in and bought bonds with long maturities. We call that on the far end of the yield curve, in an attempt to bring interest rates at that long end of maturity down. In doing so, the Federal Reserve did this to support asset prices. And while I think the ultimate debate has probably not been settled, I think the argument can be made that it certainly worked to a certain extent if you take a look at what happened to the stock market in 2009 and arguably since 2009. The downside of lowering interest rates at the far end of the yield curve, if I move back up for a second, the type of bonds being purchased by the Federal Reserve really are treasuries, but an enormous amount of those bonds were government agency bonds. We're really talking about Fannie Mae, Freddie Mac, mortgage-backed securities. The good news, or the good effect and the bad effect of that, as I said, the good effect was supporting asset prices here in the U.S., allowing the stock market recovery. The unfortunate side effect of that was, and this really affects our clients, was forcing investors who normally, perhaps in retirement, preparing for retirement, would normally be investing in these bonds, expecting a halfway decent yield to supplement perhaps Social Security, other sources of income, and you could get a decent yield without taking a lot of risk in a Fannie Mae or a Freddie Mac or even a U.S. Treasury bond that was out 10 years, 15 years, perhaps even 20 years. By suppressing interest rates at the far end of the yield curve through a massive asset purchase program, the Federal Reserve did support prices of other assets like stocks, but they also pushed investors out of these longer-term bonds into riskier assets like stocks, seeking income from other sources, income where they could no longer get from a safer bond. So that is one major aspect of the financial crisis that is still with us today in 2018. In September of last year, the Federal Reserve did outline or did begin a process of normalizing its balance sheet. So this is in process. The Federal Reserve is reintroducing these bonds back into the bond market. And one of the sources of potential volatility in the future is, when supply picks up, prices fall. And we could see additional volatility in the bond market, particularly the longer end, as this balance sheet normalization begins. Now, I wouldn't say that their transparent program to begin this process, and it really has already begun, starts with minuscule monthly sales back into the market. So I don't believe we've really felt the effect of that thus far. The other thing to talk about, which I think gets most of the press, is interest rates. And just a quick review, interest rates, when we talk about interest rates, we're talking about the federal funds rate, the Fed funds rate. This is the overnight rate. This is the rate which the Federal Reserve controls, and it's the rate at which financial institutions lend each other money overnight. As you can see from the chart in front of you, this actually goes all the way back to 1999, and you can see where the Fed funds rate has been. I mean, it's been as high as 6.5%. More recently, it's been as high as a little bit over 5% prior to the financial crisis. In that extraordinary bear market in 2008 and 2009, you see that the Fed funds rate tumbled all the way down to, we'll call it virtually zero. In 2015, the Fed began a very methodical, well choreographed, or I should say maybe well broadcast process of getting interest rates off the bottom. This is an important thing. Interest rates, the Fed only has so many tools to control monetary policy, to help spark the economy if it looks like the economy is slipping into a recession. Interest rates have always been the primary tool the Fed has used. Manipulating the federal funds rate down to zero by itself, an extraordinary measure, didn't seem to be enough in 2009. Ben Bernanke, chairman of the Fed at that point, began quantitative easing. We saw the balance sheet just a slide ago. But this process of raising interest rates currently, that's been going on since 2015, there were 3 Federal Reserve rate hikes in 2017, is a process of normalizing the Fed funds rate without higher interest rates. And the reason the Fed really has to do this, without higher interest rates, if there is an economic problem in this country, and we are not forecasting this, but if there is an economic slowdown in this country, the Federal Reserve at a 0% interest rate level has virtually no tools left in its toolbox to kind of spark the economy. This chart in front of you, you see the gray line is the Fed funds rate. We see a 1.38% average ending Fed funds rate at the end of 2017. Now, the Fed stayed in a range, so it's 1.25% to 1.50%. The midpoint is 1.38%. But from that point, December of 2017, you'll notice 2 tails that move off to the right, really predicting future paths of the Fed funds rate. The lower tail, on your screen it may appear brown, shows essentially what the market expects the Federal Reserve to do. And again, this is as of the end of December. In the blue tail that takes a steeper path up to 3.06% is an actual result of the Federal Reserve's Board of Governors voting. They get together during the FOMC meetings, they vote, based on your projections, where do you think interest rates are going to be a year from now, 2 years from now, 3 years from now. The market expectations are found out really through the futures market. The extraordinary thing about this chart is that there is a large divergence between where the market expected interest rates to be next year, 2019 into 2020, and where the actual Fed sees interest rates moving. And this divergence speaks directly to a lot of the volatility we've experienced over the last week. I would note here, and I think it's interesting, that the market for the last 7 years or so has generally been correct. The Federal Reserve's outlook for growth in the economy has always overshot the mark. In this particular case, or I should perhaps say last week, everything seems to have changed. So it was the expectation. Good news is bad news. Good news is bad news in the very short term. What sparked this? We saw the market rate all of a sudden snap back up, match the Federal Reserve's outlook, and perhaps even exceed it a little bit. And that happened because of last Friday's economic reports that come out from the Department of Labor. We had exceptional non-farm payroll numbers. About 200,000 people were hired in the month of January. But more extraordinary, or certainly more unexpected than that, was evidence of something that's been lacking in this recovery for the last 8 years, and that is wage growth. Wage growth came in at 2.9%, and that took the market by storm. So you had a major shift in a very short order of a number of interest rate hikes that the market was expecting, frankly, 2.5 rate hikes in 2018. At the end of last year, the Federal Reserve themselves came out and said after the December meeting that they expected there would be 3 rate hikes. Right now, the expectations are somewhere from the market between 3 rate hikes and 4 rate hikes for 2018. So this big shift in expectation is what causes volatility. It certainly caused volatility in the bond market, But as we have pointed out before in our outlooks, interest rates lie at the very center of all asset valuations, stocks included, certainly bonds, commercial real estate like the building I'm sitting in. You can figure out you can figure out the present value of future cash flows, but you need interest rates to do that. Higher rates generally mean lower asset prices. The other thing I want to touch on briefly is the nature of volatility itself. If my chart book will cooperate with me. There we go. Hopefully this has come up. Volatility is a mean reverting mechanism. A couple things about volatility, one thing about volatility I'll talk about in the short term, and one thing I'll talk about volatility in the longer term. In the short term, volatility follows what we call a time series regression, a time series pattern. Volatility tends to beget more volatility, and that is true until volatility basically burns itself out. That's a short-term issue. I mean, it can last a week, it can last a month, it can last a quarter. Over the longer term, volatility is a mean reverting mechanism. What you're looking at in front of you was the chart that appeared in the outlook that we sent out last month. And essentially the red line is the realized volatility of the S&P 500 going back 40 years. 40 years of realized volatility, and I look at this chart and I think if you didn't know what the chart was depicting, if you didn't know what the numbers were on the axis, if you were an alien coming to this planet and just looked at that chart and tried to guess which way that red line was going to go next, I think most beings would say, hey, the next move for that line is up. But you can see sharp rises in volatility are generally followed by troughs in volatility. Rises in volatility often coincide with choppy markets. Troughs in volatility often coincide with the kind of the meat of bull markets. So we have pointed this out repeatedly in our outlook, but having spoken about volatility, when you've heard about the fact over the last 12 months there's been almost no volatility. When I hear those words, whether it's on CNBC or I read those words in the Wall Street Journal, I think we all now know that, hey, there's been really no volatility, it's coming. The problem is, it's very difficult to tell why or when volatility will kind of reemerge. But we did suggest back in November that we thought interest rates or perhaps even inflation might be the cause of future volatility. So volatility is mean reverting, and the other thing I would want to point out, because again, our theme today is a return to normalcy. For readers of our outlook, this is a chart that will probably be familiar. This covers a span, again, the last chart was 40 years, this is 38 years, covers a span of 38 years. And essentially is showing us above the line the return of the S&P 500, and below the line is the top to bottom point during each one of these calendar years where the S&P 500 actually touched before finishing its year. For example, you see that in 2000 and this is, I'm going to count here, 2008, 9, 10, the S&P 500 actually ended up with a positive 13% return, but not before top to bottom it dropped 16%. The point of this chart is that the average correction in the stock market over this period of time is 13.8%. Even a month ago, we would have looked at this updated chart, and that number really would have been about 14%. We put this chart in our outlooks on a repeated basis to get investors, to become aware of and used to the fact that volatility is a normal thing. There's always a reason for it, but the reason for it is found out after the fact. But in 29 of 38 of these years, you see that the market has usually checked out with a negative number before going on to experience a positive return. So this is a return to normalcy. The Federal Reserve returning to a normal monetary policy, returning to a normal interest rate regime, and volatility in the markets. This is a return of normalcy. The other thing about volatility I do like to point out is that it's a little bit more of a metaphor, but that you do need to take two steps up, one step back quite often before you can take two steps up. One can't necessarily complain about valuations in the stock market without periodic corrections to those valuations, and that is the process we are going through. We do expect continued volatility. We do expect higher levels of volatility than we've had over the last 2 years, but we expect a return to normalcy. And those are my comments for now. I'm happy to open it up to any questions. I'd remind you that if you have questions, please click the raise your hand button on the screen, and you'll be able to type your questions into the box. We do have a couple of questions currently. The first question is, it sounds like you're saying bonds are not safe. I thought bonds were safe. That's a good question. As wealth managers, we allocate assets between asset classes. To make it really simple, in its simplest form, stocks, bonds, cash. Those are your choices. Bonds. When we talk about bonds, I think it's important to be more nuanced than they're safe or they're not safe. There's different types of bonds. And even within those classes of bonds, there's different maturities of bonds and different characteristics of bonds. Generally speaking, and let me go back to this chart. Generally speaking, when we talk about bonds, bonds have a lower standard deviation than stocks. So in that sense, they're safe. Before you, 40 years in red of the S&P 500 standard deviation. Also in blue, 40 years of standard deviation of what's known as the Bloomberg Barclays Aggregate Bond Index. That's just a huge bond index like the S&P 500 that covers a number of bonds here in the United States. Certainly, there's a different level of volatility, and that is a measure of safety. It's not to say that bonds aren't and can't be volatile, and certainly it's not to say that bonds don't go down. They do go down, but they do so usually to a lesser degree than equities. Here at CCR Wealth Management, we build bond portfolios, and our bond portfolios, we pay attention to a couple different things, and we do make strategic or tactical shifts to those portfolios based on our own economic outlook. There are two types of bonds. Again, I'm being just very general. There are government bonds. We would call those risk-free bonds. Get to that word in a second. And then there are credit bonds. Government bonds in the U.S. Are treasury bonds, T-notes, T-bills. In that category, we would also include agency bonds. These are bonds, unlike treasuries, that maybe don't carry the full faith and credit of the U.S. government, but they're seen as being a moral obligation of the U.S. government. We saw the United States step in wisely or unwisely and bail out Fannie Mae and Freddie Mac back during the financial crisis. But they're government bonds. Because there's no credit risk, because the U.S. government can print money, these bonds are seen as being riskless. But that doesn't mean that they're not exposed to the nature of interest rates. Interest rates and bond prices have an inverse relationship. Rates go up, bond prices go down. Government bonds, risk-free bonds, have a pure interest rate relationship. On the corporate side, because corporations can't print money, they are subject to paying a premium over treasuries when they issue bonds. This premium over treasuries tends to act a little bit as a cushion in their volatility when it comes to pure interest rate volatility or the sensitivity of these type of bonds to volatility, because you're getting paid a little bit more in the coupon. That's the main difference between credit bonds and corporate bonds. CCR Wealth Management, for the last many years, I'll say 6-7 years, has had a very heavy footprint in credit bonds. There's all different types of credit. There's super safe credit from a credit standpoint, AA rated, AAA rated bonds. There are high yield bonds, otherwise known as junk bonds. But there's also, in both types of bonds, different areas on the maturity scale. So the longer term your bond is, the more sensitive it is to interest rates. Manipulating all those various characteristics of bonds is really how we tamp down volatility in a bond market, but bonds do fluctuate. And again, raise your hand if you have questions. Okay, that's not a question, that's a statement. We have another question. Does everything you're saying also apply outside the U.S. to foreign investments? That is a good question. We do talk about foreign investments not infrequently in our Outlook communication. Maybe there's a couple charts that we can bring up. One thing I did write in the Outlook, I think it's important to point out, is that we are at different areas in our market cycle than the rest of the world is. And this is called mouse malfunction. The chart in front of you, sorry. U.S. is a comparison of the United States and the all-country world index. I can get this up here. In the gray line, you have the S&P 500. The purple line is, again, the all-country world index, x the U.S. They take the United States out of there. So we'll start by pointing out a couple things. 2009, that was the financial crisis. Of course, both markets have rebounded to some extent, but I'm going to use the term Europe and non-U.S. fairly interchangeably here, but Europe is the next largest economy. But you did see a stumble with much of the rest of the world. Kind of the center of gravity of that was in 2014, 2015. So in the media over the last 3 or 4 months, I think I've heard, and it becomes narrative. You hear it so often, but you're hearing that, oh, this is a synchronized global growth recovery, and GDP is synchronized. The only thing I think you can say about that is both the U.S. and the non-U.S. are both heading up economically in terms of GDP. But as you see, the United States, and this is just judging by the markets, the United States has not dipped back into recession since our recovery in 2009. Not so with the rest of the world. Europe in particular, our largest trading partner, and that's why it's important. You recall the Greece debt crisis, which frankly still goes on. The issue with the pigs, so-called pigs, it was Portugal, Greece, Spain, Italy. Basically mired in debt, looking for relief from the European Central Bank, and austerity policies ensued, and Europe essentially dipped into a recession. It was certainly, I think, self-induced, but at the same time, it was a recession nonetheless. Wasn't a particularly deep recession, But this has changed, and we've written about this over the last years. This has changed, and what we've got now is Europe really kind of in maybe the 18th month of a recovery out of their recession. So yeah, synchronized in the fact that we are both moving up, but we are in completely different areas of the market cycle. Argument can be made that, well, it's more than an argument. The U.S. is in its 103rd month of expansion, and as I said, Europe and much of the rest of the world is in about their 16th or 18th. 46, to see if we have a better slide. I can't seem to get this out of the way. There we go. It wants to pop up in the middle of my screen. Chart on the left is what I'm referring to, but again, just another way of taking a look at this, that the recovery after 2009, Europe went back into a recession, brought much of the emerging markets with it. Japan stagnated. The U.S. got a little shaky. We're all now moving in the same direction again, but the United States market cycle is mature. It's been going on for a long time. The European Central Bank adopted belatedly the quantitative easing policies of the Federal Reserve. So there again, we are in different areas of the market cycle. We're talking about interest rates and volatility here, but in terms of the ECB and the Bank of Japan and most other major central banks out there, all of which have been providing incredibly easy money to their economies, we see no danger of rising interest rates. I don't think the European Central Bank will raise interest rates until 2019, tail end of that year, maybe even 2020. They're also currently continuing an asset buying program. Same is true with the Bank of America, aggressively buying assets. So we've been very positive on non-U.S. equities, maybe a little bit more cautious on non-U.S. bonds. The bond market over there is not quite the same. I mean, we are raising interest rates here. We're eventually going to get some decent yields here, but I've posited the question before, hypothetically, in our outlook: who buys negative interest rates like you're getting over in parts of Europe and certainly in Germany? Absolutely. Another question here. Hand is raised. Portion. Current assumptions. We cut back on bond portfolios. Current assumptions are that interest rates will be rising and possibly inflation. Does that mean that we should cut back on bond portfolios and place the money in stocks, commodities, and alternative investments, foreign investments, cryptocurrencies, or precious metals? Current assumptions are that interest rates will be rising. That is the current assumption, and possibly inflation. So let's talk about inflation for a second. CPI numbers just came out this morning, and what we call the headline CPI number was unchanged at 2.1%. What we have seen is actual growth in what we call core inflation. So strip out the most volatile elements of CPI, which are food and energy, and we have seen a marching forward of core inflation. I want to be clear that we have mentioned inflation in our outlook, and certainly the whole question about rising interest rates is to stem inflation. The Federal Reserve has two mandates. One is to promote full employment. We'll have 4.1%. Trust me, this country is fully employed. We're also seeing the labor participation rate improve. We've seen wage growth. That's happening. The other mandate of the Federal Reserve is the promotion of price stability. We do not see runaway inflation. One of the research sources that we tune into is capital economics, and capital economics did make what certainly at the time was an out of consensus call back in the fall of 2017, and their expectation was for 4 Fed rate hikes this year in 2018. And this is at a time when the market was thinking 2.5, and the Fed thought 3. Well, the market seems to have become closer tuned in with capital economics. Should you then take money out of bonds and put it elsewhere in the market? The question is commodities or more stocks. You know, stocks and bonds, as we saw from the volatility chart, have different characteristics. And I do not believe a strategic asset allocation, investors generally should understand a strategic asset allocation. If my portfolio is 70-30, meaning 70% stocks, 30% bonds, or 60-40 or 50-50, best practice is to achieve a financial plan. That's what we do in wealth management. To achieve a financial plan is to stick with the asset allocation, to stick with the risk profile, because asset allocation is really the defining factor of a risk profile. As I said before, there are tweaks that we will make to a bond portfolio. And the bond portfolio that CCR Wealth Management, our model bond portfolios, have done exceptionally well relative to the Barclays Aggregate Bond Index. You know, we do look at bonds, and I'm speaking purely of the index. We've had a long time forecast of 0 to 2%. Well, this is 0 to 2% forecast for the Barclays Aggregate Bond Index incorporates the fact that interest rates are rising. So, what are your other opportunities? You know, there's some significant difference in this particular question between bonds, which will pay you interest and pay your principal back, and commodities, or bonds and cryptocurrencies, which is completely off the charts, and certainly bonds and stocks. I do not believe strategic asset allocation should be adjusted. Talk to your advisor and understand what we're doing is that we are making tactical changes within the bond portfolio. Many of you will notice changes in the coming weeks or have noticed changes in the past weeks. And this is just a for example, where if you have a taxable account, we have increased or perhaps even introduced an element of municipal bonds to the portfolio. Municipal bonds tend to have a lower sensitivity to duration, meaning, that's jargon, I'm sorry, a lower sensitivity to interest rates, all things being equal, relative to corporate bonds and certainly relative to treasury bonds. That's an example of making tactical changes within a bond portfolio to become less sensitive to interest rates. 0 to 2% as a forecast is not negative. It doesn't mean that you may not end up with a negative year out of 3-4 years, but we don't have a negative outlook, certainly on our bond portfolio, as kind of a state of being for the next 3 or 4 years. So bonds are an important component of the portfolio, mainly to tamp down volatility. Shifting from bonds to stocks because interest rates are rising is only going to shift you into the kind of volatility we saw last week, where you had, within 1 week, 2 1,000-point declines in the Dow Jones Industrial Average. Probably not the answer. Does your investment advice outlook change as the value of the dollar plummets? I'll read that again. Does your investment advice outlook change as the value of the dollar plummets? That's a good question. I would say that, let's see if I can find an interesting chart here. The short answer to the question is sort of. We make tactical moves in our model portfolios all the time, and that the model portfolio has been reflected through our clients' portfolios at the point of review with your advisor, and also as it makes its way through our portfolio review committee. I would not call the path the dollar is taking currently a plummet. Consider what the dollar did in 2014 and 2015, and we would see a retracement of that move. A declining dollar is not a bad thing for U.S. companies. It is, when we know that if a dollar is declining, then another foreign currency is rising, and that may or may not hurt that foreign currency. Look, a declining dollar is a good thing for the United States exporters. We are a major exporting nation, so that helps U.S. stocks. It can hurt some non-U.S. companies when they try to export to our country. The one thing the weakening dollar may exacerbate in the months ahead, but I really think it's going to happen on the margins, is inflation. So currency fluctuations are like volatility in the market. They're normal. They also happen to mean reverting, just like volatility in the marketplace. So if you try to change your investment policy with the path of the dollar, you're going to get whipsawed, usually on a 12 to 18 month basis. And if you take a look at the path the dollar's taken over that period of time, again, I think we're experiencing reversion to the mean. Now, in the past, we have, and we may in the future, look at our non-U.S. investments and decide whether or not we want to have a hedged version of that investment or an unhedged version of that investment. But we're usually, as I said, we're making that decision on the margins and not as a wholesale change across the portfolio. Is it possible that cryptocurrencies in the future will replace precious metals as an inflation hedge? I think that is probably would be a reach. Cryptocurrencies is an interesting topic, and we wrote about it back in the fall. And I've written a couple pieces about cryptocurrencies, but it is such a brand new area of investment that the replacement of gold, for example, is, I think, highly unlikely. They do share things in common, and not the least of which is there's a finite supply of both. But I don't think cryptocurrencies are ready for prime time to the extent that they're going to replace precious metals anytime soon. Seem to be frozen here. Let's go to the top here. What is your take on the news today? The volatility index has been manipulated. This mouse is giving me some trouble, so it's like the same questions posted a couple times. $1 amount. What is your take? Here we go. What is your take today on the news that volatility index has been manipulated illegally? Does this affect our overall outlook? The news today about volatility is supposition. It's an interesting concept, but volatility was it illegally manipulated? It's difficult to say. The jury is out on that. I think it would be bigger news if it was found out to be true. The fact is that the CBOE VIX index on February 5th, had its biggest day move in history. It was up 116%. But that, it should be noted, was off such a low level. One thing about volatility and the current capital markets are that there has been a lot of invention of new investment vehicles to play just about any corner of the capital market you want to play. Many of them are exchange traded funds or ETFs. There are ETFs that track volatility. There are ETFs that track leverage volatility, 2 times volatility. One of these actually, 1 or 2 of them actually got wiped out last week. So yeah, investing in volatility, or in fact investing in in sort of a bet for the last couple of years that volatility would stay low, has been a very popular thing. You run into the black swan situation in those type of vehicles, and I think you get what you pay for. I don't anticipate, and we would not invest our portfolios as if we expect volatility, illegal manipulation of volatility is an actuality. Folks, the biggest point I can make about volatility is the fact that volatility has been negligible over the last couple of years, but that volatility is mean reverting. So I think news stories come out, volatility shot up, but it's still, certainly hasn't knocked the stock market into a bear market. But news stories start to come out, and look, if anybody's manipulating ETF or other type of trades, probably a good chance they're going to get found out. Any other questions up here? You mentioned a return to normalcy. Here's a question. You mentioned a return to normalcy. What is a normal return I should expect from my portfolio? That's a pretty good question. Surprises abound in the market. We expect a more normalized stock market, and volatility will certainly be part of that. I've already given you our expectations of the bond market. Figure that's an index of 0 to 2%. So I don't really know the asset allocation of the client that's asking the question. I might get more specific, but I definitely would suggest to clients that expecting back-to-back double-digit returns in the U.S. stock market is unrealistic. Has it ever happened before? Sure. Look, I cut my teeth in the 1990s. I remember those markets well. We're in a different economy. We're not growing at 7% GDP. We're hoping perhaps to approach 3% GDP. We do have rising interest rates. So if we take the midpoint of the bond expectations and we take a long-term return assumption of the S&P 500, I think what we would expect out of a moderately allocated portfolio, let's call a moderately allocated portfolio 60% equities, 40% bonds, looking at something in the 6 to 8% range, I think is reasonable. Is oil price also something we should be aware of this year regarding its impact on inflation? It's a good question. Oil prices, well, there's a lot to chew on with this question. Oil has this mouse is giving me all kinds of problems. Bear with me. I'll get my charts back up. Oil markets have been revolutionized in this country over the last decade or so. It's the dollar chart I was looking for. To the right of this chart is the price of oil. In the past, because oil is the number one traded commodity in the world, like dollar-weighted terms. Oil is traded in dollars, therefore it's priced in dollars. We've seen some very wide swings over the last 20 years in the price of oil. We can all remember, I think it was even higher intraday than $135 a barrel, about $145 a barrel, as I recall. And then, in the depths of the financial crisis, oil dropped down to, to $20 level. The thing about oil prices and our expectations going forward is that we think oil will be a lot less of a hedge against inflation as a real asset than it has in the past. Like gold, like precious metals, it is a commodity, it is a finite supply of it. But the development of drilling techniques, the technology to extract oil in the U.S. market has had a profound effect on the price of oil and the likely stability of the price of oil. What essentially the U.S. oil producers have done in this country over the last 15 years is put spigots in the ground all over the country, where they can quickly ramp up or reduce their rig count to extract oil from shale through fracking and adjust much more quickly than they've ever been able to do in the past to the price of oil. So you see on that chart on the lower left-hand side, U.S. crude inventories and rig count. You notice when the price of oil goes up, the number of rigs goes up. The price of oil goes down, they can quickly disassemble those rigs and adjust the output production of oil to the demand of oil. The other thing is that we've seen a major decline in the power of OPEC to sort of hold the rest of the world at bay with oil manipulation. So oil as a hedge against inflation, I think will have lost some of its power. Hedges against inflation really are going to, I would think, remain precious metals and gold in particular. But I do want to reiterate that I don't expect a runaway CPI number to begin anytime in the near future. So hedging against inflation is less important to us at this point. Folks, I'm going to stop there. Once again, I appreciate everybody taking the time to join us today. And if you have any questions, get in contact with your financial advisor, and we'll be happy to answer them in that method. Thanks again.